We looked into how the stock market works in our last episode. But what if you do not have enough knowledge or the time to identify a good business to invest in? That is where a mutual fund comes in. We'll take a closer look at it in this episode. Hello everyone, I am Vijay Mohan and you are watching Investment Insights. What did we learn from the stock market episode? A company is divided into a huge number of shares, and the investors who are interested in investing in that company can buy any number of those shares. A mutual fund also works in a very similar way. It is also divided into a huge number of units, and interested investors can buy any number of those units. So, what does a mutual fund do with all the investors' money? Depending on their investment objective, they can invest in any type of asset, mostly in company shares and bonds. Each mutual fund has a professional fund manager who decides where to invest the money. So instead of you doing the hard work of identifying a good stock to invest in, the fund manager does that for you. And of course, the fund manager is going to charge a fee for that effort. Let's look at an example to understand this better. You are looking at the mutual fund Vanguard Dividend Growth Fund. It has a unique ticker VDIGX to identify this fund in the market. You can see its objective in the product summary section. This fund is designed to provide investors with some income while offering exposure to dividend-focused companies across all industries. So basically, they are investing in quality companies that offer good dividends as income. Good profitable companies share their profits with their investors through dividends. This fund is specifically identifying and investing in those companies. Let's go to the Morningstar website to see more information about this fund. By the way, Morningstar is a good platform to analyze a mutual fund. What you see as NAV here is net asset value, the value of one unit of this mutual fund. This NAV price is calculated by the end of the day after the stock market closes. It changes every day depending on the price changes of underlying assets. They also deduct the mutual fund fees as part of the everyday NAV calculation. Total assets shows the total value of all the assets in this fund, including the cash. Expense ratio. This is an important value that we should pay attention to in every mutual fund. This is the fee they charge for fund management. For this fund, it is 0.27%. Adjusted expense ratio includes or excludes certain fees for easy comparison across funds. So this fund charges a total of 0.3% on fees. That would be $3 per year for every $1,000 invested. But as I said before, these fees are not charged once a year. It will be charged every day. This fund has a total asset of $52.3 billion. 0.3% of that would be 156.9 million. For one day, it would be 156.9 divided by 365 days, almost $430,000. So they will deduct this $430,000 from their total assets of 52.3 billion as their fees. The end of the day NAV price reflects that change. Though the 430,000 looks big from a total assets perspective, it will be a very small amount in the NAV price, 0.03 cents. Next, we should focus on the investment style of this fund. This specific fund invests in large blend category. Usually, it is represented in this grid format. Market capitalization is the size of the companies that this fund invests in, and the investment style ranges from value to growth. A value company would be a company that has value which is not truly appreciated by the market yet. It has the potential to go up in value soon. A growth company would be a company that is growing aggressively in its revenue every year. This specific fund is investing in large companies with a good blend of both growth and value. If you want to look at the companies this fund is investing in, you can find that under its portfolio section. This fund is investing 88% in US companies, 9% in non-US companies, and holding 2.7% in cash. You can see the sectors of this fund as well. The topmost holding of this fund is TJX companies with 4.11% exposure. You can check how a fund is performing under the performance section. This specific fund is performing the same as the index in the last 10 years. A $10,000 invested 10 years back in this fund would have grown to 34,756 by now. But overall, we can see that the index line red is trending above the blue line of this fund. The performance of a fund is totally dependent on the talent of its fund manager. We have historical data that shows more than 80% of the fund managers fail to beat the index over the long term. If we know that fund managers have a hard time beating the index, what should we do? We should invest in the index itself. We'll take a closer look at index funds in another episode. In India, you should look for another value in the fund, whether it is a direct fund or a regular fund. Direct funds are offered by the fund houses directly to the investors and so less fee. Regular funds are offered through another middleman, and so the fees or the expense ratio is bigger for them. It is to your advantage to buy a direct fund rather than a regular fund. You should see whether a fund is direct or regular in the name of the fund itself. So if you are in India, always make sure that you are buying a direct fund. We do not have that problem in the US. Each fund has the same expense ratio regardless of where it is sold. You should be able to buy a mutual fund through any brokerage like Vanguard, Fidelity, or Charles Schwab. If you are in India, you can either buy the funds directly from the fund houses like UTI or through brokerages like Zero the Coin that offer direct funds. Now there is another version of these funds, ETF, exchange traded funds. We'll take a closer look at them in the next episode. Thanks for watching.